Hello and welcome to Morningstar. I'm Emma Wall and I'm joined today by Blake Hutchins, manager of the Investec Global Quality Equity Income Fund, to give his 3 stock picks. Hi Blake.
Hi Emma.
So what's the first stock you'd like to highlight today?
Yeah, so I selected a US stock to start with, which is ADP. They're a very high quality business and they provide human capital resources for companies, and they'll do everything from payroll to recruitment, and also they benefit from the outsourcing trend of HR in the US and in Canada. Actually, they pay 1 in 6 people in the US, which is an interesting fact.
Does that mean it's quite linked to how the domestic economy is doing in the US? We've actually seen record low unemployment in the US, which presumably is quite good for this company, but is it sensitive to those kind of changes?
Yeah, at the margin. I mean, they have very much a recurring revenue stream, which we like, which provides defensive nature across a cycle. About 90% of their revenue is actually recurring each year. So whilst there is some element of cyclicality to do with employment, actually across a cycle, and you see in the last recession, they actually grew their revenues. They're currently growing about 8% top line, with margins also progressing. So we actually like the defensive nature of the business and the very cash generative nature of the business.
And what's the second stock today?
So the second stock, I picked a European stock, which is Kone, probably the best manufacturer of lifts and escalators in the world. They have grown very strongly in China recently, and there's an interesting element to that in that it presents a little bit of risk, which we found gave us the valuation opportunity to get involved in the stock. But then also the way that Kone make the majority of their money is through servicing the lifts. So once they've installed them, for years, the safety and the servicing element of those escalators and elevators is so important, and that's still very much happening in China. The health and safety standards are increasing in China all the time, which is a great long-term driver of Kone's business.
And I suppose the great competitor of that is Schindler's Lifts. How much market share does Kone have, and is that a concern, or is it this recurring revenue that really is interesting?
Yeah, it is, and it's actually what we think is the real opportunity for Kone is for its installed base of lifts is to make sure that they service those lifts that they have installed. Currently in Europe and in the US, the proportion of lifts that Kone manufacture that they service is around 80%, but in China that's only around 50% or less. And as those standards become more important, Kone can actually benefit from that. And then in terms of market share, to your point, there's an interesting replacement cycle that's due to happen in Europe. We have a lot of old buildings, and so it's not just about China. There is a replacement cycle of original equipment in Europe to happen on a 5 to 7 year view as well.
And what's the third and final stock? So
the third one is a UK stock, and it's one that I tend to get a lot of questions on. So I picked GlaxoSmithKline, actually. It's the biggest holding in the fund, and we've been encouraged by recent results with Glaxo. They now have separated their business into 3 very sensible divisions: pharmaceuticals, vaccines and respiratory, all of which are, in our view, and consumer, not respiratory. So those 3 divisions in themselves are very high quality. All of them have growth prospects, they have high returns on capital, they are cash generative, and they are capital light, all features that we look for when we analyse stocks for the fund.
And the pharmaceuticals industry in general, their share prices suffered a few years ago, quite significantly, when people were worried about this patent cliff. They've rallied since then. So at this valuation, are you still find Glaxo compelling? We do, actually, and there's still a lot of self-help to come from Glaxo. If I think about their consumer division, they're actually only making operating margins of 11% in that division. Reckitt, which is another holding of ours, they make mid-20s or 30% margins in a comparable division. So we like the self-help angle with Glaxo, and also they've got a pretty good run of time now where there won't be any more patent expiries. So we think they're pretty well set, despite some of the controversy that's out there in the market. Blake, thank you very much. Thank you. This is Emma Wall from Morningstar. Thank you for watching.